Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us today. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Higher energy prices drove Canada's inflation rate up to 2.8% in April, reaching its highest level in nearly 2 years. The conflict in the Middle East continued to push up gasoline prices, and they rose by 28.6% compared to a year ago. Price growth reached its fastest pace since May of 2024. It was still lower than the rate economists were expecting. Shares of Sherritt International are getting a lift. The company says it's no longer proceeding with a dissolution of its Cuban joint ventures, including its split from Cuba's General Nickel Company. It will instead maintain the suspension of its direct participation in the activities. Sherritt says it is evaluating ways to mitigate the impact of U.S. sanctions. It cautioned that any transaction or restructuring remains preliminary and may not be completed. We are watching shares of Agnico Eagle today, up 3.4 right now. The miner is going ahead with a large gold mine in Canada's far north. Agnico has given the green light to the Hope Bay mine in Nunavut and plans to spend more than $2 billion on initial capital costs. The project has been hailed by the federal government as an anchor for economic development in the Arctic. And a quick look at the markets. And you can see another down day right now. It's not as off on Friday. Of course, yesterday closed for the holiday, but right now it's down by about a quarter point, being dragged down by materials, which is down 3.5% right now. South of the border. And the sell-off there happening as well. Tech stocks taking a beating. Nasdaq is off by 1.1. S&P 500 off by 0.75 of a point. Well, NVIDIA reports earnings this Wednesday, and the stakes couldn't be higher for a market turbocharged by billions in AI investments. But that same AI boom has triggered a crisis for the software industry. We're going to unpack exactly what all this means for your tech portfolio with our guest, Jamie Murray, president of the Murray Wealth Group. Jamie, thanks as always for joining us.
Thanks for having me.
Looking at the numbers today, can NVIDIA... What's unfolding right now? What's driving it with the Nasdaq and tech in general?
Yeah, certainly we've seen tons of volatility this year, from the Iran war to software stocks being obliterated in February and March, and now we're seeing it on the hardware side. So we're seeing the names that are tied to the NVIDIA supply chain take it on the chin over the last couple of days. But this follows, a run where many of these stocks were up close to 100% over a 30, 40-day period. So I think it's natural that we're seeing some pullback. Interestingly enough, the 13Fs, which are what U.S. investors file, like hedge funds and large fund managers file, showed some prominent betting against the AI infrastructure market. So I think that's why we're seeing some selling over the last couple of days, particularly. That was the catalyst, but it's always natural to see a pullback. And especially with NVIDIA's earnings up on Wednesday, there's certainly a little bit of nervousness in the market. Have we gone too far or too fast?
Is that worrisome when you see some betting against that and it having or seeming to have a bit of an impact on the markets?
I don't think it's too worrisome, at least not how we invest. Like, we're long-term investors, so we're focused on what is a company going to be making in 2, 3, 4 years. I mean, certainly there's been a lot of bubble talk about AI over the last, really since ChatGPT first launched in 2023. So you're going to see these pullbacks. We've seen them as along the way, but we've continued to see the market, and particularly these AI stocks, continue to march higher despite that volatility. So we're not necessarily nervous about it. We think NVIDIA, which we own in our Global Equity Growth Fund, is going to have very strong results on Wednesday. There's obviously good news out of China last week that China is going to be allowed to purchase some NVIDIA GPUs, some of their older units. So that's a catalyst there. And we still think there's going to be strong spending through the end of the decade. So we don't think this is over by any means.
All right. And with NVIDIA, what's a good report from them? It seems like people's expectations are so high.
Certainly, they're high. NVIDIA works hard to manage expectations. And we've also seen the street be a little bit behind. I think if I was to pull up NVIDIA's beat ratio over the last 8 to 10 quarters, it would show that they almost always beat revenue, and it's just how much have they beat by, and is that going to satisfy the buy side investors that are doing their own modeling? So obviously we'll have to see what the report says, but we're certainly expecting a strong report and ongoing optimism from NVIDIA CEO Jensen Huang about the future of AI spending.
What would be worrisome to you from NVIDIA?
That's a good question. I mean, what would be worrisome? And it's hard to pinpoint because, all external indicators are calling for huge demand. I mean, certainly supply chain risk, and if there's going to be a lag in rolling out some of their new products, that's probably the most prominent risk I would look for, whether they're, as they move on to next generation GPU rack scale solutions like the Vera Rubin. And then I think it's called Feynman is their next one coming out in 2028. If there's any indications that these products maybe aren't performing as they should, NVIDIA always tries to have a huge step up in performance every time they launch these new solutions. And so any indication that those future generations aren't going to perform or show the same improvement that we've been seeing over the last 3-4 years.
All right, one group that's not been enjoying the run that a lot of the other tech software. Have we hit bottom yet?
Yeah, I think we have. Obviously, you don't hit bottom until you look back 6 months later and see that, we're actually up 30-40% from, and the narrative, particularly around the sector, has changed. That's when we know we will have hit bottom and we're on the way up. So I can't say for sure that we're there, but it certainly feels like there's tons of negativity about the future of software. Software is more than just the bits on the screen. I mean, there's the enterprise focus of the organization, its ability to create products and bolt on new abilities to that software that their customers want. And I think there are some great software companies out there. Now, there definitely are going to be losers in the software market, and that's where investors need to choose between the winners and the losers. But these big banks like Morgan Stanley and Goldman Sachs, they make these baskets of software stocks that investors can quickly buy or sell or short. And a lot of, I think, long-term software winners were lumped into those. I mean, I think ServiceNow, which is now up about 20% in the last 4 sessions, is a perfect example of one of those companies.
And what do you like about that?
Yeah, so what we like about ServiceNow is, and this is a new holding for us, we just bought this in the last couple of months on this sell-off, is they are really ingrained across multiple vectors of an organization. So it's not just that they are selling a point solution, they're really ingrained in the core DNA of how an organization is structured, how data in that organization is taken in, how it's ingested, how it's spit out to run reports, to run different modules. And it's not just the amount of data and the data history, it's the governance of that data, the security. And ServiceNow is really being a leader in our eyes in terms of using and building AI tools on top of their platform solution that allows the end user to then safely build additional AI abilities using the ServiceNow control tower, as they call it, as the base layer for all future AI activity.
All right, we just want to get in one more stock you want to talk in, not quite tech, but I mean, they have some techie stuff, I guess, some of their outfits. Lululemon.
Yeah, so I just wanted to highlight Lululemon. This is a company that we bought within the last year. We think it's a great deep value play, and it's obviously topical in the news right now. The former founder, Chip Wilson, is trying to get some of his own board members installed on the board. And we actually agree with a lot of what Chip is saying, and that's why we think there is opportunity here. Lulu has lost its product focus a little bit. The product is stale. They're having to mark down a lot of their inventory to move it out. But this is still a company that has like a strong heritage of DNA, of athleisure, of technical apparel that consumers love. And I think if Lululemon can find its way back to what it was, call it 5-10 years ago, this is a stock that's trading at 9 times price to earnings ratio. even just getting the U.S. market, its biggest market, to grow 5 to 10% annually, we could see the stock double from here.
Okay, we have to wrap it up there, Jamie, but thanks as always for joining us.
Yeah, for sure. Thanks for having me on.
Jamie Murray, President, the Murray Wealth Group. Up next, shares of Matter got a boost last week after the Canadian tech and manufacturing company reported its latest earnings. We'll break that down with the CEO when we come back. Canadian Advanced Materials and Infrastructure Solutions company Matter saw its shares jump last week after it reported earnings that showed solid execution, helping offset a typically slower start to the year, with strength in its composite technologies business driving a higher outlook for 2026. We're joined now by Mike Reeves, President and CEO of Matter. Mike, thanks very much for joining us.
You're welcome. Good morning.
A couple of numbers here. The adjusted EBITDA, $39.6 million, beat consensus by 29%. Revenue, $321 million, almost $322, beat by 7%. What drove that?
I think we're seeing the market react to an inflection point in our business performance. Our Q1 beat and the improved full-year outlook really, I think, signals improving fundamentals, stronger execution as we emerge from a multi-year transformation. In the quarter itself, we saw strongly improved operational efficiency. We saw strength of sales into mining and North American transportation markets. And we continue to see a modestly favorable direction in the energy market, which I think will play out further as we roll through the year.
And the strength of sales, was that across the board?
It was particularly in the composite technology segment, where we are the North American market leader in the supply of underground fuel storage tanks to both retail fuel stations as well as to AI data centers and a number of other infrastructure projects.
Now, is that Xerxes?
Xerxes is the brand name, and yes, that business has performed extremely well early in the year. Demand is at an all-time high. Backlog in that business is at an all-time high, and the execution within the business allowed Xerxes to deliver its strongest first quarter in history. So very proud of the team there, but they have a lot more they can accomplish.
And does that look? Yeah, I was going to say, does it look like that's going to carry on? And does that demand? Do you expect it to continue?
I think we continue to see that demand grow, and that's why we've invested in a brand new factory for that business, which came online last year and is ramping up production. So our expectations for that Xerxes business is that year over year, we can deliver 10% more tanks, and I am quite certain that we can sell every tank we can build. So that business, I think, is set for a multi-year growth and margin expansion journey.
So no worry about a bottle. You're thinking, do you have bottlenecks now, or you're just adding capacity?
We are just adding. We've worked very hard to localize our supply chains across the entire corporation and make certain that we limit the risk of exposure as we think about tariffs and other trade friction. And in Xerxes in particular, we are very well positioned. Supply of materials is free and clear of interruption. We have seen a little bit of an increase in costs for things like resins, which is largely a result of rising oil prices. But broadly speaking, we can pass those through to customers and maintain our margins.
And the tariffs, are tariffs not having too much of an impact?
They are not at the moment. I think at this point, we would say that tariff risk is probably abating across our organization. Everything we manufacture is USMCA or CUSMA compliant. We reconfigured our North American manufacturing footprint over the last 3 years to ensure that largely we manufacture where we sell. So we have a robust US footprint today and an appropriate Canadian footprint. So less and less of our products have to cross borders, which obviously keeps the risk on the tariff front as low as we can manage it.
All right. Now, FlexPipe, a bit of the other way. The volumes were off for it. What happened there?
So North America is our largest single market for the FlexPipe product. This is where we sell to oil and gas producers and allow them to move oil and natural gas from a newly completed well to their existing infrastructure. Total well completions in North America was lower by a little more than 10% in Q1 26 versus Q1 25. So that had some impact. But broadly speaking, after seeing about 4 years of lowering demand in the oil field space, we are confident that the beginning of 2026 represents a low point in the cycle. And from here, I expect to see onward and upward growth, both in terms of North American activity and in terms of share gain. We've invested very heavily in FlexPipe to expand our product portfolio, and now are in a position to really attack effectively the full breadth of the available market. And as we noted in our Q1 earnings call, post-quarter, we captured a meaningful international order for FlexPipe. That's the first time in about 2.5 years that we've seen really substantial international order activity. So I have a bullish view of both North American and international demand for FlexPipe products.
How big is that potential market, do you think?
So our largest competitor is approximately twice our size, and I have good confidence that we can approach their scale over the next 3 to 5 years.
All right, so ambitious. Let's talk a little bit about AmerCable, but it's a little over 16 months, I guess, closing in on a year and a half. How are things coming together there?
So we acquired AmerCable early in January of 2025 and could not be happier. The team there have proven themselves to be incredibly talented. The performance of that business exceeded our expectation in calendar year 2025, and they've had a good solid start to 2026. Within that business, our largest single exposure is to the mining markets, both North America and international. We're very bullish on the demand for mining activity across a wide array of minerals and are well positioned to take advantage of that. So we are investing over the course of this year and next to bring additional productive capacity online in AmerCable, which I think will allow that business to not only deliver great margins, but also begin to grow at something closer to a double-digit percentage rate.
And is that tied in with, you had $104 million in operating cash flow in 2025? Is that where some of the money's going? Where else do you see that money going?
That's correct. So we've invested very heavily over the last 3 years. So what you'll see in 2026 is a more modest degree of capital spending, somewhere between $35 and $45 million. The largest single component of that will be investment in AmerCable.
And M&As, anything on the radar there?
So we've worked very hard to make sure we onboard the AmerCable acquisition and really extract full value from that activity. With most of that work now complete, I think we're back in the market to take a look at potential accretive, strategically aligned acquisitions. I'd say late this year is probably a realistic moment for that window to reopen.
Okay, Mike, we have to go, but thank you very much for joining us.
You're very welcome. Thank you.
Mike Reeves, President and CEO of Matter. Coming up, today's market drivers with Bloomberg's Monique Molina. Time now to take a look at some of the market movers for today. And for that, we're joined by Bloomberg Equities reporter Monique Molina. Monique, thanks as always for joining us. And we're talking some energy, X-Energy right now. What's going on with them?
Yes, so X-Energy, their shares are trading higher this morning after they received analyst initiations that were really positive on the stock. Among analysts tracked by Bloomberg, they got 5 buy ratings and 2 hold ratings. This is a company that had their IPO a few weeks ago. It's a big nuclear energy firm, and they also have backing from Amazon, which was something that the analysts were really positive on. They already have agreements in place with Amazon, Dow, and another customer for when they are able to bring their nuclear reactors online. So analysts really see this as a strong backlog and pointing to that their technology is really standout compared to some of the other competitors in the marketplace. They do note that the company is still pre-revenue, but because they already have this backing and because they also have a specific technology that they're one of the only companies that has, they really see a lot of opportunities. And this technology they use is more efficient for their uranium, and they see the company also being able to sell at least that technology to others as well.
All right, Hyperliquid, State Street buying into it. What's going on there?
Yes, so Hyperliquid, their shares are up quite a bit today on that, as well as the fact that the SEC is expected to allow trading of tokenized securities, which basically means stocks that are traded as crypto tokens, which will allow 24/7 trading, and Hyperliquid and the Hyperliquid network and the Hype tokens, which this company owns. Those are used for tokenized assets already. They're in other jurisdictions. They're used for tokenized stocks. They're used for tokenized commodities. So this company is expected to be one of the beneficiaries of this change if the U.S. Securities and Exchange Commission follows through on this. So a lot of people are really optimistic that they're going to see a lot of growth from this new market.
All right, and Agnico Eagle, people excited about the new mine up north.
Yes, so Agnico Eagle, their shares are down this morning, but that's just because gold prices are down today. They're actually outperforming their peers, and that's because people are excited. Like you said, they announced today that they're going to be building a $1.7 billion gold mine in Nunavut. And analysts are really positive on this news. They say this is going to help put the company on track for its goal of reaching 20 to 30% growth over the next decade. And they also expect that this mine is going to increase production at lower cash costs, which they see is really positive. They do note that it has higher capital expenditures than were previously thought, but they said the benefits from the growth in production is going to be able to offset these higher costs, and it's still going to be really positive for the company overall.
All right, we have to wrap it up there, but Monique, thank you as always. Bloomberg's Monique Molima. When we come back, Google and Blackstone are planning an AI cloud company. We'll break it down for you after this. Higher energy prices drove Canada's inflation rate up to 2.8% in April, reaching its highest level in nearly 2 years. The conflict in the Middle East continued to push up gasoline prices last month, which rose by 28.6% from a year ago. Price growth reached its fastest pace since May of 2024. It was still lower than the rate economists were expecting, though. Shares of Sherritt International are getting a lift. Up to 9% right now. The company says it's no longer proceeding with a dissolution of its Cuban joint ventures, including its split from Cuba's General Nickel Company. Now it will instead maintain the suspension of its direct participation in the activities. Sherritt says it is evaluating ways to mitigate the impact of U.S. sanctions. It cautioned that any transaction or restructuring remains preliminary and may not be completed. Shares of Hive Digital Technologies are soaring today, up 6% right now, after the Buzz HPC, a cloud and data center subsidiary of the crypto firm, announced plans to build an AI data center in Toronto. The 320 megawatt facility will create one of North America's largest domestically controlled AI clusters and is scheduled to go online in the second half of next year. Blackstone and Google are planning a joint venture to create a new U.S.-based cloud company. Under the terms of the partnership, Blackstone is making an initial commitment of $5 billion U.S. in equity capital, and Google will supply hardware, including TPUs, to meet the growing demand for accelerated computing. Let's get reaction now from Rohit Kulkarni, Managing Director at Roth Capital Partners. Rohit, thank you very much for joining us.
Thank you for having me.
Okay, what brought this together? Who's winning with this, and what are they liking about it?
I guess broadly, AI and AI infrastructure, it's not just a software story anymore. It's a more of a financing story. It has a real estate angle. It has a power angle. So if you think of kind of two leading companies in their own sphere, you have Google in technology, Blackstone in real estate, and their access to power. I think having a joint venture to essentially succeed in one of the biggest infra build-outs that we're seeing makes sense. It also till date, it has been an NVIDIA story of GPUs. Google's TPUs are fast followers, and Google is trying to do what NVIDIA tried to do over the last 5 years, that increase the ecosystem around its own AI infrastructure.
All right. I'm going to ask about that in just a sec, but in the markets, both of them are down now. Is that just the general day, the way the market is going right now, or is that in response to this announcement, do you think?
It is. I think I wouldn't specifically think that the stocks are down because of what this announcement can be drawn into. It is just overall market sentiment towards AI infrastructure. The broader sentiment, the worry here is the amount of capital that is going to be required to fund this infrastructure globally is rising, and that is leading to worries as to at what point do we start to see too much capital flowing into this infrastructure, and when do we start to see the returns on that capital? I think that's just a broader sentiment. I wouldn't characterize today's stock moves to this announcement specifically.
And speaking of funding for this, where Blackstone's putting in $5 billion, where do they see the rest of it coming from?
I think this is just the tip of the iceberg, in my opinion. $5 billion. To put that in perspective, Google alone is probably going to spend on its own capital expenditures this year north of $180 billion. So $5 billion is just, as I said, a tip of the iceberg. Probably a starting point similar to what many years ago, 3 to 5 years ago, NVIDIA started with investing in companies like CoreWeave, companies like Nebius, where they were almost seeded as NVIDIA GPU cloud companies. So Blackstone and Google hope to do the same with Google's TPU. So I would expect that number to rise over the next months and quarters.
Now, is that the competition for this new company, Nebius, CoreWeave?
I think so. I think this new company is trying to replicate exactly what the Neo Cloud template has been. I call these companies as Neo Clouds simply because we have the old traditional internet cloud, the ones that Zoom is working on, the ones that you use for Netflix and Disney Plus. The AI cloud are new companies that are pure play companies to crunch a lot of compute, a lot of data. CoreWeave and Nebius are the leading AI cloud companies, but there are probably another 20 to 30 private companies out there that are trying to compete on that same field. So all of them use NVIDIA GPUs. Very few companies use Google TPUs, and Google's in-house silicon has gotten so much extra demand that now they feel the need to start evangelizing it through such partnerships.
And with the TPUs to NVIDIA's GPUs, how do they compare? How would they replace?
So I think from in-house silicon basis, I think all 4 large companies, Microsoft, Meta, Amazon, and Google, have been working on this side project, if you will, over the last probably 5 to 10 years. Google and their TPUs are probably the most advanced in that pack of in-house silicon by 4 large hyperscalers. Having said that, in a layman's terms, I would say TPUs are probably 12, maybe 24 months behind NVIDIA's GPUs. So what you're buying today from Google is probably what you could buy from NVIDIA 12 months or maybe 18 months ago. So there is a gap in the price and the performance that Google is offering. Having said that, there is a large market. The tide is rising very quickly. So there is a lot of asymmetry between supply and demand, and that's where Google has a product in the market which has growing demand as well.
And what do you see? What's next? Is Google going to continue in this direction, trying to find new investors and start new companies, or is somebody else, another of the Mag 7, going to step in and do the same?
I think I wouldn't be surprised if Amazon, with its own Trainium chips, starts to make moves similar to what Google is doing. Amazon's Trainiums are considered to be, again, a few months behind what Google is offering in the market. In my opinion, Google is probably going to do more of such deals. Probably we are going to see more AI cloud seeding announcements, and that probably puts some pressure on these neo cloud companies that have till date completely been reliant on NVIDIA's GPUs. So there is more competition in the market. That's probably the reason why some of the neo cloud companies are reacting negatively today. But my read at a 30,000 foot view level is the market is large. The AI inference and compute market is significantly larger than what we thought it would be 6-9 months ago, given the agentic AI wave. And companies like Google are doing the right moves here to evangelize their AI infrastructure ecosystem and essentially take partnerships with companies with access to power and real estate, and no better than Blackstone right now.
Okay, we have to wrap it up there, Rohit, but thank you very much for joining us.
Thank you so much.
Rohit Kulkarni is Managing Director at Roth Capital Partners. Coming up, we'll see how an AI-fueled investment cycle is already reshaping markets and why companies are still in the early innings of defining their long-term strategy this after the break. Markets are increasingly being powered by an AI-driven investment cycle that is reshaping valuations. Earlier, Bloomberg talked to Kevin Brunner, Global Chair of Technology Investment Banking at JP Morgan, who sees real-world impact from AI as companies are in the early stages of focusing on their long-term strategic narrative.
It's impacting every client that we have. There's not a client that we talk to that's not actually thinking through where they are in the landscape, what's their long strategic narrative, and how they're going to adapt to a changing environment.
What's driving most of the tie-ups right now? Is it the idea of trying to get economies of scale? Is it to shore up cash, to invest more efficiently, or is it just sort of a quest for survival?
You know, I actually think the M&A market could be defined by selectivity, scale, and really creativity these days. And so we're obviously seeing strategic acquirers be highly selective in where they're putting their capital use. The deals they're doing are actually done with high conviction, and they're actually changing the long-term narrative for a lot of these companies, and that's probably the number one focus. At the same time, scale's very important. So cash flow to be able to reinvest in the business is very important. We've seen the equity markets really embrace what I would say is scale overall. And frankly, when you're going through business transformation at the same time, scale's been very important to be able to fund that. And then creativity's been the most interesting part. We've seen deals of all type, minority investments, we're seeing collaboration, we're seeing consortiums do deals together, we're seeing partnerships, a lot of structure, and that creativity, I think, is something that's really very interesting to me as we look forward.
What are some of the barriers to these tie-ups? I mean, how high is the threshold? We've been talking all about how bond yields have been surging to the highest levels going back to 2007, at least in the 30-year in the U.S. Globally, you're seeing long-term yields rise. At what point does that stymie some of the activity in deals that we've seen so far?
You know, I think capital has not been putting a barrier on M&A whatsoever. Obviously, we have a constructive regulatory environment. And at the end of the day, I think while we're trying to balance all the geopolitical and all the macro issues that are out there, at the same time, it's so imperative that many of these companies change their long-term strategic narrative, that we're seeing people push forward, do deals of size, and making sure they're actually repositioning themselves on the chessboard for the path forward.
We've seen a lot of mega deals so far this year. That has been the driver, at least in the overall volumes. Is that the same in technology? Does it have a different flavor?
Yeah, it's a great question, because technology a little bit is a tale of two cities. AI is actually a catalyst within technology, and it's also a disruptor. So we're actually seeing those companies with AI tailwinds be very acquisitive, adding capabilities, adding different tools to their system, and making sure that they're continuing to reposition themselves to be the leaders that they are today. On the other side of the technology market, we've obviously seen a little bit of a pause. We've seen people assess their own business models. Where are they in this evolution? But I actually think that uncertainty as we go forward is going to actually turn into differentiation in the marketplace. And that differentiation is going to lead to continued consolidation, more traditional M&A activity, I think, in the second half. and we're really enthused about that.
Can you put some specifics around this in terms of what we're actually talking about? I mean, is it the hyperscalers versus the software guys that are all fighting for survival, that are all going to try to band together or else die?
Well, let me tell you where we think we'll see differentiation on the software side, right? So we're going to see, obviously, companies of scale. We'll see mission-critical platforms come through the other side. We'll see systems of action, right? Obviously, I think there's a lot of discussion around SaaS moving to an outcome-based platform. We'll also see what would be companies with data moats come out the other side. And that differentiation, obviously, we went through one earnings season. We're going to go through another one here in a couple months. And I think we're going to lead to those that are actually have reassessed their models. They put the moat around their business. And I think those are some of the characteristics we'll see.
Would you say in the next year this is going to be a big shakeout period where some of these models get put to the test in the way that they haven't so far? Which are the ones that actually can be deployed in an effective way and those that can't and that ultimately go away?
100%. I think we're going to continue to see, and maybe see even a little bit more than we have today, the capital kind of focus into the winners. This is more on the hyperscalers, large providers, really building out the infrastructure. On the other side of the market, we're going to see consolidation, right? As we hit that point of differentiation, we're going to see the winners. The winners are going to be acquisitive. The winners are going to add to their portfolio. They're going to apply the same techniques that they actually applied to their own business, and we'll start to see them build their scale along the way to have all the benefits that we were talking about previously.
How much pushback are you starting to see from investors, whether it's the private capital or whether it's public markets, in terms of financing some of these transactions, given how much risk is coming in and given the competition for capital elsewhere?
Yeah, investors have actually been very resilient. Investors obviously on the top of the market, right, where there's a lot of growth and there's a lot of AI tailwinds, everyone wants to participate. We've obviously seen a pause on the other side of the market where the transformation's taking place in the business models. But as that differentiation starts to happen, we're going to see investors be very focused. I mean, I expect, take private equity, for example, let me back up. Private equity actually has been very focused on being patient, assessing their own business models. They're part of the creativity I talked about. But as we move through to the second half and we see that differentiation, I think we're going to see capital for take privates. I think we're going to see capital for consolidation. And I think that'll come from both sides of strategic and financials.
Do you think that we're going to see also a lot of failures among some of the private equity firms that have had companies that have not gone public for a very long time because they couldn't reconcile the valuation that they were booking versus the valuation you could get in the markets, and they have to kind of do something with that in order to free up cash to be able to go out there and do something?
Well, a number of the private equity veterans are obviously very AI savvy, very focused on the transition. We're actually reading now, about some of the new announcements, partnerships, collaborations that are taking place. And I think we're clearly going to see some winners, but with all success, there's obviously some that'll be on the other side of it.
This is one of these annoying questions that help benchmark where we are. Where are we in this process? I hate using the innings kind of analogy, but I'm going to use the innings analogy. Where are we in this process of build out with respect to AI?
It's still early, but as I look at the conversations taking place here at the conference, we've really moved from it just being AI, agentic, infrastructure build out to actual execution and scaling as part of the plan. Every company here is very focused on what's their long-term strategic narrative and are in the early stages of doing so, but we've actually gone from hype to real execution and scaling.
Coming up, Nissan could soon bring Chinese-built electric vehicles to Canada as Ottawa opens the door to cheaper EV imports. We'll have more after the break. To see what's on the radar. For that, we sat down with Nadeem Kassam, Chief Investment Strategist and Portfolio Manager at Marno Private Wealth Counsel. He told us why Amazon is showing up.
One of the key things that we've seen across the Mag 7 is they came in and out of favor. So last year we had the broadening out of the trade, and call it November of 2025, and you started seeing these sell off, and that perfectly aligned with just the tremendous amount of capex spend that the Mag 7s or several of them were announcing, right? And so. When we take a step back, it's a name that we own. We own several of the Mag 7s. And what we like about Amazon is that it's more than just the AI trade. So first and foremost, it's the largest online retailer.
Yeah,
right?
and people would be surprised at how much Amazon is.
Exactly, right? And so that is a key part of their business. It's a lower margin business, but it is pretty sticky, right? And another key component, I'll get to the AWS side, but another key component is advertising, right? And that's been growing at a double-digit clip, 22% year over year as of the latest quarter. The area that we like a lot is AWS. And so AWS is by far the largest cloud infrastructure in the US and globally, I would argue. Questions around AWS has just been the monetization of the CapEx, and we're starting to see early signs of that, or we saw that in Q1, which was consistent with our views. So Q1, AWS revenues grew by almost 30%. Margins came in at upwards of 38%. And so the question prior to earnings releases was, are they able to grow revenues without any margin compression, right? And so there's a lot of bears out there really questioning that. Not only did we get strong revenue growth, we got strong margin, strong margin levels, and we saw backlog upwards of $200 billion, which is the largest we've seen in the last 4 years. So, that is very supportive of the underlying build out of the AWS and AI infrastructure, and they're seeing underlying demand, and that's especially if we exclude Anthropic and OpenAI demand that was recently announced.
All right, I want to get to a couple others here.
Sure.
We're on a tight line on this
Sure.
one. CNQ. Is it the perfect Canadian stock?
Look, it's a great Canadian producer. It's the largest Canadian producer, one of the largest independent in the world. I think if we go back to what we're seeing today with just the chaos within the Strait of Hormuz, the shortages of crude in the world, inventories being drawn down at, call it, let's say, 13 million barrels a day, likely going forward until we get some resolution. This is a core name to own for Canadian investors. Again, who knows what happens with the Hormuz crisis, but again, it's a very high quality energy producer, long life assets, 31-year reserve life, and a very, very low cost of sustaining capital to maintain or get those barrels out of the ground. At a $40 break-even US dollar WTI, this is a cash flow generating machine, $13.5 billion expected this year at an $84 US WTI. So again, we're sitting at a well over 100 or slightly over 100. And I think it's a very attractive entry point, especially given that the company is going to start buying back shares at an increasing level once debt levels fall to about $13.5 billion on a net debt to cash flow. So again, the return to shareholders is going to continue and accelerate heading into 27. And we feel like it's a very strong, high quality producer that investors should own as a core holding within their portfolio.
All right, let's get to the last one, Brookfield Infrastructure Partners.
Yeah, so we talked about inflation. Inflation is not going anywhere, and it's definitely going to be sticky. I would refrain from using the term transitory, as we've seen coming out of the COVID crisis. Brookfield owns critical infrastructure globally, and so that's across transport. So think about roads, tolls, ports, utilities, midstreams, and also data. So again, this is another way of playing the data play without paying the hyperscaler multiple. Key things to know: 85% of their FFO is indexed to inflation. So if inflation goes up, this is a natural equity hedge within a portfolio. So we like that, and this is a company that has delivered time and time again, year after year. So they've delivered 14% FFO growth since 2009. Valuation looks attractive. So another name to insulate the portfolio from elevated inflation, especially if we see that going out forward.
And that was Nadeem Kassam, Chief Investment Strategist and Portfolio Manager at Marnoa Private Wealth Council. Nissan is exploring plans to export electric vehicles made with its Chinese partner Dongfeng to Canada, aiming to capitalize on growing demand for lower-cost EVs. For more on this, let's bring in David Welsh, Detroit Bureau Chief at Bloomberg News. David, thanks very much for joining us.
Thanks for having me here.
So what might this mean? I mean, there's a cap in Canada. How many vehicles is Nissan thinking about?
Yeah, it can't be a big number because the Canadian government doesn't want this big influx of Chinese-made cars coming into the country or built there. But I think given the tension with the United States, they do want to look at other sources of vehicles, maybe put a little pressure on the Trump administration, but also make sure that they've got a source of cheap cars for Canadian buyers. For Nissan, they've had real struggles in Japan and in North America. Their sales have been flagging. They've been trying to turn the company around with a freshened product line. And I think if they could get a cheap vehicle in, designed in China, made maybe even with Chinese parts, and sell it for under $30,000 in the Canadian market, I think they would find a lot of buyers, and they see that as a way to start regrowing market share in a region where they've been struggling.
And is that reasonable, that price for Canada? Could they get one here and have it made and have it here for 30 grand?
Look, it's sort of for instance from me, but they do have some pretty cheap cars that they make over there. The cost tends to go up when you have to meet Western safety requirements, and sometimes you have to make the vehicles a little bit more roomy. But you're not looking at expensive vehicles here. You're looking at something that, I would think would be, at worst like $50,000 and probably under that. But the whole spirit of the conversation was these would be inexpensive EVs that they would sell to Canadian consumers. So I would think it'd be more under 40, maybe even closer to $30,000. It'd be something that they had in mind because Chinese consumers at that end of the market aren't paying huge amounts of money for these vehicles either.
Anyway, we've got about 30 seconds, but Tesla is now doing that too. They're looking at bringing their Chinese-made vehicles to Canada and shipping the American-made ones back.
That's right. Look, Western companies are struggling in China, and for a variety of reasons. And what they're trying to do is either find places to sell their production, and that means exporting it someplace. And I think that was Tesla's plan. Or if they can develop cheap vehicles with a cheap supply chain and build those vehicles in Canada and gain market share, I think they'd be happy to do it there. But the tension between the U.S. and Canada has really created a lot of opportunities and a lot of ideas for the car companies on what they can sell there.
All right, we've got to wrap it up there, David, but thank you very much for joining us. David Wells, Detroit Bureau Chief at Bloomberg News. And that's it for Morning Markets. Thanks for joining us. We'll see you back here tomorrow.